Hello, welcome back. Other than the financials, there is a very important reason why I really love holding Facebook, which is actually currently my largest holding, with Alibaba being my second largest holding. There is a reason for that. Of course, I have talked about the financials of Facebook in quite a few videos, and it's extremely important what they are doing financially, of course. But I also really appreciate the social network effects, the social networks, and the effect that they have in our society, and especially marketing and sales. Because some people may not really understand and may be thinking like, okay, privacy issues and Facebook is actually governing our lives, and people are actually posting videos and photos and all that jazz. But Facebook is an advertising platform. And advertising is huge. If you have ever owned a business, you would know about it and you can understand and evaluate that. And it's very important because it controls pretty much the globe. Pretty much almost everybody has an account. And this means that they can advertise to everybody. And the stock price went down massively because of the Cambridge Analytica scandal. And this is where I bought a lot of stock, and this is why I'm up right now, even as the company is actually deteriorating in terms of its stock price. I still bought at like $150 back in 2020. And I did that because I can really understand what the company is doing in terms of advertising, and I don't really pay much attention to what people are thinking about in terms of privacy and stuff, because that again doesn't affect their business model and it doesn't affect their bottom line. And so this is why I feel that taking a look at important, at least very important advertising platforms, as I like to call them, and social networks for what other people like to call them, is important because they can make a ton of money for us investors. And so in this one, I wanted to examine Snapchat. And again, this doesn't mean that Snapchat is an automatic buy because Facebook is a buy. We have to examine it on its own because not every company of that sort is the same, obviously. And so we're going to take a look at Snapchat in this video and examine the financials of the company and see what they are doing and whether it's worthwhile taking a look at this company and buying it. First of all, let's take a look at the company profile here just to get a quick glimpse at how many employees they have. They're moving with the market. 1.01 is the beta, of course, a US company, and a relatively recent IPO. Let's take a look at the stock analysis tool. Let's go back and let's take a look at the chart here. You will see it takes a little bit of time to load because it's loading a lot of data here. It's actually loading the max chart as well. You will see that the company had its IPO at about $24. Right now it's sitting at 33, down 60% from its 1 year high. Massively down. Okay. What has been going on in the last year? So yeah, the company has been going down as well, of course. So yeah, the company is in a massive downtrend and 4% down in the last trading session. The P/E ratio of the company is minus 109 and it's actually going down. And this is a dire picture here because it tells us of a company that has negative earnings that are actually going down. And so that's a bad thing to see. The price to free cash flow ratio is positive, and you may be wondering why and how this is happening. I will explain as we take a look at the financial statements later. The outstanding shares, the company has been issuing shares. I would expect that because they need to be making money somehow, and since net income is not their thing, they'll have to issue shares. And quite a few total liabilities when compared to the free cash flow that the company generated last year, which is probably also slightly manipulated, as I will explain a little bit later, legally, of course. So the 5-year revenue growth, 400% because the company has been growing, and you would expect that. That's the good thing about these kinds of companies. Net income growth also actually growing, but it used to be negative, right? Remember, and it's still negative. So okay, they may reach profitability. Free cash flow growth, however, has been negative and now it's positive, and we will examine why. 5-year total equity growth is increasing, I'm pretty sure because of selling shares. Otherwise, why would it increase? Doesn't make sense. And not much debt here in terms when you compare it to equity. Remember, they are issuing quite a few shares. It's about 20% more, so that's significant. Yeah, their margins are negative because they're not making money right now, so the return will be negative. Okay, but I want to examine things in detail here because this gives me a very first picture. And using this you can just immediately even avoid the company, but that may not always be the case, and we want to be examining things in more detail here, and this is where we can see the details, and that helps a lot. And so you will see that the company has been growing revenue. These kinds of companies can really grow the revenue, and that's the good thing about it. But what about their net income? The net income is also growing. It was negative, but it's growing upwards, so that's a good thing to see here. And I like the fact that with the increasing revenue, the net income is increasing as well. So that's a very, very positive sign for companies that are not profitable yet. So I like to see that, of course. In terms of the balance sheet, I'm pretty sure we're gonna see additional paid-in capital here. Of course, in the billions, the company has been issuing tons of shares, like expected. And in terms of the total equity, it's increasing. Pretty much has a lot to do with the extra shares that they have been issuing. As you can see here, a few billions in terms of shares are actually skewing this upwards. Okay, so let's take a look at the cash flow, because this is very, very important. Now, obviously, the cash flow starts becoming a thing because it's correlated to net income, right? Net income is the top line here. And so we're having, let's just say, take a look at 2021, minus $500 million loss over here. And now you will see that stock-based compensation is added back to the cash flow statement because it's a non-cash expense. It's actually a compensation with stocks. So it's extracted as part of an income statement, and this is why you're looking at negative net income. Here it's added back as a stock-based compensation here, thus turning this positive. But practically speaking, this is not cash inflows. These are basically sort of like adjustments because of the expense of stock-based compensation. It's an accounting thing that does make some sense, but some people don't realize what's going on here. So it's good to know why you're seeing this kind of positive values here. It's not about the net income of the company being positive. And this is why I really like the way we're doing it in our stock evaluation tool. You can immediately see the story here, because immediately you will notice that the revenue has been growing here, but take a look at the net income margins. They are negative, all of those, right? So that makes a ton of sense, because the net income of the company has never been positive. And so if you look at it here, you will see the free cash flow margin being 24%, but with the net income margin being, the net income being negative and the free cash flow being negative, you're getting a positive number here because both are negative. But again, we're talking about a negative net income and negative free cash flow. So this is indeed 24%, this value is 24% of the net income, yet it's negative. Both of these values are negative. And typically speaking, we want to be seeing positive values here because we have no profitability here and no free cash flow here. And so here you will see, for instance, zero profitability, losing money, yet positive free cash flow. And this is why we're getting minus 37% in this case. This is 37% of this value, pretty much. And so this very, very handy table here really helps us understand what's going with the company. It paints a picture, paints a story about what the company is doing. And I do appreciate that the company is actually growing their revenue and is actually growing their margins. So eventually, I'm pretty sure they will become profitable. But the problem is, what are we paying today is the thing. Because the company could become profitable, but how much are we willing to pay waiting for this thing to happen? And we typically, as value investors, we don't want to pay for something of this sort today and pay too expensively and just wait to reap the rewards 20 years from now, because we would have overpaid and we could actually feel it in the future. So we don't want to speculate. We want to have something precise, something that makes sense in terms of what the company is doing. And so in terms of revenue, I do expect that the company will be growing a lot. So I'm going to give it the benefit of the doubt. I'm going to go very high in terms of revenue growth. This is a 5-year free cash flow growth, discounted free cash flow model. So this can actually happen for sure. But the net income margins are negative here, so we don't have something positive to go with. However, we are seeing that they are growing and growing every year. So at this growth rate, maybe I'm willing to take it to, let's just say 10%, and 12 and 14 here is what I'm willing to make a leap of faith about. And be like, okay, I'm expecting this to have a net income margin of 10% in the upcoming years, 5 years. Because if it has a negative net income margin, it doesn't make sense to pay anything. Because how can you really calculate how much to pay for a company when it's not profitable? Like if I want to sell you something that's actually losing money, would you buy it? So it's the same thing with a company. Of course, there is growth though, for sure. But the thing is, and the problem is, and the risk is what you are paying today. And so this is why we are using a projection calculator here, and we are establishing a scenario in which the company is actually making money, because nothing else makes sense. It never makes sense to buy something that doesn't make money, practically speaking. I mean, because you have any investment is about the money it generates. If it doesn't generate money, it's not worth it. And of course, growth plays a role. definitely. And again, this is why I'm willing to use these kinds of scenarios. And when you get your hands on the tool, you can actually use your own numbers. You can potentially use like 1 or 2 or 3% here, which probably even makes even more sense. But I wanted you to understand that when an investment doesn't make money, you are taking up a lot of risk, and you should be paying much less because of that risk. So the free cash flow margin here is sitting at the 21% is being the average, as you'll see here. But remember, very important, these numbers were negative here, so this is not a real 24% here, because numbers were negative. It's not that out of 3.4 billion we made 417 in net income over here, or 827 million in free cash flow. These are all negative numbers, so these are losses, and so we cannot really use this. Now, typically, with a company that's doing fairly well, you typically want numbers around 80, 90, 100, 110 in terms of the free cash flow margin. So I'm going to go 80, 90, and 100. Again, thinking that the company will achieve free cash flow margins that make a lot of sense. And so I'm going to be using 50% for my annual return here. And the reason for this is that I have way more risk, and I'm actually taking a lot of leaps of faith here, as you see. I'm actually using numbers that currently don't even make sense, and I probably wouldn't be looking at this company right now. But yet again, I want to be using the tool just to picture how much I would be paying today if I would be willing to actually take on some risk here, this kind of risk that this actually projected with these projections here. Let's hit calculate, and you will see that even with taking so many leaps of faith here, and being super confident about the company, we are still getting that the current price is much more elevated than what we'd like it to be. So we're very positive in terms of our estimates, very aggressive here. Still, our high estimates are at $15, and this is why I wouldn't be purchasing the company today. I would really have to wait for them to actually prove to me that they are worth the money that they're asking for the stock price. Because if I'm paying this money today, $33 per share, I could actually end up getting severely damaged, and you can kind of see that already with people who have bought at previous levels when the stock price was even much more expensive, $83, and now they're down 60%. And the problem is you can have many companies that go down 40%, 50%, and still be doing tremendously well, one of which is Facebook, for instance, because they are making the money to actually make a case for themselves, because they are making the money, the free cash flow, that eventually investors would like to get their hands on. But with this kind of company here, the slightest thing goes wrong, the company starts losing some revenue, starts losing some steam. What's going to happen with your stock? That's the big risk. So thank you for watching this video. I hope you enjoyed and it helped you a little bit with your decisions. Let me know what you think about Snapchat, and I'd love to hear from you, and leave a comment below. And remember to like the video and subscribe. I'd love to see you around, especially when I'm going to be giving you information on how to access this tool in a few days. So you want to stay around for when that happens. Thank you for watching this one. And in the meantime, take a look at this video that I made earlier, and it's about SAP, very well-known HR management software company. Thank you for watching this, and I'll see you soon. Bye-bye.